Well, hello everyone. Welcome to Trading a Smaller Account. I am coming to you live from Anaheim, California. We are on the eve of the last market drive of the year. So if you haven't registered and you live in the Anaheim area, feel free to come and register on site tomorrow. We're expecting, somewhere in the neighborhood of 1,000 of you and your closest friends. So can't wait to meet so many of you. What are we going to talk about for this next 45 minutes we have together? Well, we have 4 trades that have hit either targets, 3 hit targets, and 1 hit an exit. So we're going to have a look at those. We have a little bit of trade management to do, and man, am I doing the gallows walk on that. Because we have a lot of bullish trades on, and we have a few in the trades gone, not right category. So we're going to look at those. And then we're going to play some new example trades as we always do. I want to thank, first of all, Mike Fairborn for being here in the chat. He's a friend and a fellow coach, and we're glad to have him on board. If you've got questions, please don't hesitate to ask, because Mike is an expert in all of these things that we're talking about today. And between Mike and I, we should have answers for you. If you're watching this in the archives, as the majority of people do, just know that you too have a voice. And if you type in a comment down below, I do look at those on pretty much a daily basis, and I'll get back to you quickly. So hello to Kay and Roger and Chris and Ray and Marcus and Josh, who I think will be here this weekend. So looking forward to seeing you. To Jay and Frank, and her name was Lola, and the rest of the gang. Thank you all for tuning in and being so participatory in the chat. If you're not following Mike and I in the Land of X, you're missing out. At Barb Armstrong CS and at Mike Fairborn CS. And just a reminder before we start looking at all these example trades, know that 1, options do carry a high level of risk and aren't suitable for all investors. 2, we use the Paper Money software application on the Thinkorswim desktop platform, which is a brilliant place to learn, hone your strategies, make sure you understand them before you consider trading them in your live account. There are some nuances and differences. One is that a short option positions will never be assigned early in Paper Money, and that can happen in a live account. And yes, I have seen it happen. So we're going to do a super quick market overview. On Fridays, Kevin, and it's typically James Boyd, I think this morning it was Connie, do a really great market overview. And every day except Friday, they are archived. So I hope you choose to check those out. We're going to do some new example trades, as we always do, and then we're going to do a little bit of trade management. And don't think that one of these is more important than the other. If you're joining us here for the very first time, you may think like, don't spend any time on, managing existing trades. I don't have those trades on in my Paper Money account. But the concepts are really important to understand. And if you're playing along with us and you're placing these trades in your Paper Money account, you understand that, as important as it is to know when to enter a trade, it's just as important to know how to manage things once you get in. Okay, that's, I've done a bunch of example trading plans that are in the trade management mini session playlist, and all of them include 5 components. What to trade, when to trade it, like when is the entry, how do you position size, like how much to trade, when to exit, whether the trade goes for you or against you, and then what are your trade management routines? What are your routines once you're in a trade? Okay, and we cover all of those in this class on pretty much a daily basis. So there are some upcoming events. Anaheim is tomorrow, as you know, which is why my background looks a little different today. And then Houston, December 11th and 12th. That's first day is Intro to Technical Analysis. Day 2 is Intro to Options. And then the weekend before Christmas, I had thought nobody would show up, but last year it was apparently packed to the rafters, an advanced options event in Miami. So a great reason to be in Miami at this beautiful resort. And I'll be there at all of these along with Ben Watson and a cast of other people that we've flown in from all over the country, to serve you and your educational needs. Okay. So this class, we started this year with 25,000. Our max position size is 5,000, and the amount of risk we're willing to take per trade is no more than 500. Okay, Chris is saying he'll be in Houston. And Roger's saying it's sold out. So if they have closed Houston, if you come the day of, they will register you on site. But yeah, you're better if you know you want to go to one of these things, they're free to register. So just get registered. And Chris said, he was at the Chicago event. He'd highly recommend it. They feed you and treat you like kings and queens. So for the market drive events, at every event, we'll have the coffee on. We provide breakfast. And we also provide lunch. At the market drives, there's also a wonderful reception, at the end of the day with, great hors d'oeuvres and drinks and the whole thing. So, they really do an amazing job on these. And I wish I could take all the credit for them, but I just show up to help out and love getting the opportunity to see so many of you. Okay, so let's come and look at the SPX. Now, we are down to the 100-day moving average, which appears to be acting as support here. We have not spent a lot of time there in the last 6 months. Like, in fact, for a lot of the last 6 months, you would have needed binoculars to see it. And we crossed that. Let's see, let's go to a year-to-date chart. We crossed that 100-day moving average back the middle of May, hit our bottom this year on April 7th, and we've been uptrending pretty much ever since. But it's still, people are starting to catch their breath, and some would say that Chicken Little has maybe been, doing at least warm-ups in the yard when you've had a pullback of, over 5%. But does that, put us in correction territory? Not necessarily. Yeah, not necessarily, but it's still a lot of pain, especially if you have short-term positions on that are bullish. And when we look at the NASDAQ, kind of more of the same. Year to date up still 14.5%, but we have seen, from the bottom to the top here, a pullback of almost 9%. They say you can call it correction territory if it's over 10%. So, we're kind of sniffing around that 10% level here on the NASDAQ. And again, coming down to that 100-day moving average. So it is a drawback. And if you're saying, well, she's saying not to worry, I'm not saying not to worry, but I'm saying, after such an incredible run, like if we come back out to, from this low here in April to this high, that's a 47% run. Still, even with the pullback, at one point it was up 58%. So, is this unexpected? Not necessarily. Okay. So what about the small caps when we look at the Russell? Pretty similar pattern, right? But still up 6% year to date. I didn't say this, the S&P, but, it's still up 12%. And the Dow, this one is a little different index in that, it's based on the price of the stock, not the market cap of the company that it represents. But, today we're seeing, a pretty bullish candle, a bullish Harami pattern here. And again, it's come down to that 100-day moving average. I guess I can get rid of these other lines. Clear my drawing set. And then what about the VIX? Our volatility or fear index, it's coming down today, like almost, it's as of right now, 8.5%. But at 24, it's in the high end of the range that we have seen this year. And like Chris said, like the short-term positions can be the problem. And that's where sometimes when we do have these conversations and we talk about, do you want to go out a shorter period of time or give it a little more time? When we have something like this happen, if you've given yourself a little more time, then you've got more of an opportunity to recover. Than if your time is more compressed. Okay, so let's look at the trades gone well. So we had both a short put vertical and a long call vertical on the Google. And we put this trade on here on November 3rd. Okay, and then we had a long call vertical, the strikes were at 280 and 285, and then the short put vertical, which we were expecting it to stay above at 275 and 270. And so that hit our targets on Wednesday of this week. So if we come here and we look at Google, we don't want 150 days. Well, we go 30. Just makes it easier to see. So when we look at this November 3rd, we did a long call vertical and the short put vertical. And how did those work out? Well, let me bring up my drawing tool. And so those, both worked out well and they hit our targets. And when we look at the long call vertical, here we got in at 255, and on the 18th or the 19th, we got out at 410. So what did we make? It was 410. Oops. Okay. 410 minus the 255. So that was $1.55, and we did two of those. So in total, we made $310 on that. So that was a base hit. And, we're happy with that. And why did we do two? Well, we were risking $255 a contract. So that was, $510. So that was in our range of acceptability. And our return on risk, because we could have lost that entire $255, would have been $155 divided by $255. So that was 60%. So that was 60%. Now let me just change colors. With the short put vertical, we were paid to get into this $1.50. And we bought it back on the 19th again for 30. Now, and so, our net gain on this was $120. Okay. And so that's what we made, was 120. But another base hit, we made that $120. Now, what were we risking? Well, we were risking $5, the difference between the strikes, minus the $1.50. So we were risking $350. And how much did we make? We made $120. And so that was a 34% return. Now, do you look at that and say, well, geez, we made 60% on the short vertical, on the long call vertical. So why would anybody ever trade a short put vertical again? Because, depending on where you put your strikes, you might say, well, we see the probabilities as potentially being higher with, the odds of it being successful are higher because it's a little more forgiving. This is a more directional trade typically. And again, it depends on where you put your strikes. Yes. So somebody's saying you took risk on the same stock twice. And yes, we did do that. And so you might not, if you were trading in your live account, place both trades because then you're risking in total 1,000. Okay. But we did this so we could have this conversation about comparing and contrasting. And so with the long call vertical, it's more directional in that it had to move up through the top strike and stay there. So, and we do try and follow our rules here. Now, it looks in this one like I did another. Yeah, no, we did these two. Okay, so that's that one. Okay, so we did another one. So these two were bullish. Then we did a long put vertical on Adobe, which was bearish. And the nice thing about this, now remember how I said I used to want to get all the possible return? And if we were waiting for all the possible return, now this trade would be going against us because today, it's up 3.5% or $10 a share. And our strikes were at 325 and 330. We put it on November 3rd, which was this day. And sometimes I don't go back, as part of the class and really review the trade entries. But we had a stock that was downtrending. We had a trade below the low of the high day, so that was considered an entry, and it did come down. And we ended up out of that one. Oh no, sorry, this one wasn't the third. Activate. This one was the 14th, which is probably closer to here. So we got in on this day. Okay. So I misspoke there. And then it hit our target on the same day as the others, which was the 19th. And our target was a 50% gain. And usually I make these gold, because we made a little cheddar or added a little gold to our coffers. Okay. And so we wanted it to stay below the 325 and the 330, just long enough for it to hit our 50% target. And so when we come back and we look at this one, we got in for 250, out for 375. How many did we do? 2. Why did we do 2? Because we could risk $500, and we were risking how much? We were risking $250 a contract, so we had $500 at risk. Our net gain was $1.25 a share, or $125 a contract. So in total, not counting commissions, it was, or transaction fees, we made $250. So that was another base hit. And this one is pretty easy to do the math on the return on risk. 125 divided by 250 per contract, that's 50%. So we made 50% right on that one. Okay. Okay. So that's those three. Now, those three, we all had a smiley face on because those made money. There was another one that we ended up out of, which was CSX. And let's look at the chart. And so CSX was a stock trade, and we bought the stock on this date. It had been in a sideways range, came back, and we said, what if we traded it just up to the swing target? And if we come back and look at the 1 year on this, well, you don't have to come back that far. It looked like it was maybe setting up an inverted head and shoulders and on its way to complete the second shoulder. Yeah, that didn't work out. And so we had a stop in place, and we got stopped out on the 20th on that one, which was the state here. And I usually make these kind of red because we shed a little blood on this one. So this one did not go according to plan. Oh, I canceled it. Sorry. I meant to make that red or pink. Okay, so how much did we lose? So if we come to our monitor tab, we can see we paid $35.72 to get in. We got out for $33.89. So how much were we down on that? $1.83 a share. So we were down by $1.83 a share, and we bought 140 shares. Why 140 shares? Because we could take a position size up to 5,000, and we did. And so in total on that one, we were down $256. And 20 cents. And there were no transaction fees on this one because this was a stock. But I would say this was also a successful trade. And you may be going like, what? What? You know, what is she saying? Well, I say it's a successful trade because we followed our rules and we had an exit in place. Because if we hadn't done that and we hadn't put an exit in place before we got in to identify when we were going to get out, both if the trade went for us or against us, you know, we could have ended up still in this trade and it could continue to fall. And then what happens? Then we start, you know, throwing around the 4-letter words like hope, like we start hoping it will go back up. You know, and that is not a trading strategy. Hope is not a trading strategy. So that was one that we followed our plan. So in that way, it was a success. It's just one of those that didn't end up making money. And, you know, how has that worked out for us so far this year? Well, you know, this has been a tough week. You know, if you look at, oops. And this is an example trading account. Sometimes we get paper money fills. We were at 31,780 at the beginning of the week. We're down almost $1,000. But we started the year at 25,000, and this is paper money, and the year isn't done yet. Like I should stop saying that. Let's just call it 31. We're close to 31 divided by the 25 we started with. So we're up 24%. So, you know, we're beating all the major indices. You know, and we've got 14,000 sitting in cash. Okay, so now let's do, where am I time-wise? Let's very quickly do a little trade management. And this, you know, I wish I could just skip and say, well, we spent so long. But, you know, like this is where you start doing the gallows walk. Because look at all these long call vertical trades that are just doing really badly. And here's another one. So somebody's saying like, hey, I'm not following the rules. Here's another case where we didn't follow the rules because we're not supposed to risk more than $500, right? But we did 2 long call vertical trades on LAM, and this one expires today. So we lost 100% on that because it's saying, you know, it's now worth nothing. And the other one that is December 19th, and where we're going to compare and contrast a longer expiration date and a shorter. Well, this one, it seems to be moving up today. So let's go look at LAM. This is a 160, 165 LRCX. And, you know, we should have been out of that one earlier. So when we look at this and we say, well, today we have a Harami pattern and and also a hammer, and we have until December 19th for it to come back up. Okay, so, you know, we could, in this case, just say, well, let's look at it Monday, and if it keeps rallying, we'll stay in it, and if not, we'll just exit. Because we have had this kind of extraordinary move in the market, and this is one where, you know, a good part of that $1,000 that we're down this week is this. Okay, our Google, we're up only 14%, so we're going to leave that. We must have 2 that we're comparing. Nope. 280, 285. Huh. Okay. The other one that I wanted to look at today was Micron. We're down 76%, and Roku and Microsoft were down 56%. And our guideline is if you're down 50%, we're going to exit. And this one, we're not only down over 50, it's down again today. So we're going to come to Microsoft. And this one has broken this support level. So, you know, we could end up losing how much more? We could end up losing another $220. And so, you know, our rule is if we're down 50%, we're going to exit. So we're going to come down to Microsoft and, you know, we are going to cancel and replace that order and we're going to get out. And so it's like admit when things haven't gone your way, admit when you're wrong, and exit the position. Okay. So that is Microsoft, and we're exiting that. And these are long call verticals. And sometimes we're going to look at these and we're just going to say, hey, everything is looking fine. We're just going to leave it alone. But Microsoft, we're going to exit. Micron looks like it's starting to rally today, but we're down 76% on that. And again, this is like lamb. We've got this harami. And so we'll look at this one on Monday. If it's not up dramatically, then we'll just exit. Well, if it's down 50%, Chris, sometimes like we'll have, you know, an extraordinary move like we've had in the tech sector and in the market overall. And it, you know, but with Microsoft, it also broke that support level. Here, it's broken a support level, but today it looks like it might rally. And so if we're already down, we might just give it that one more day. Now, if it continues to fall, then we're out. And the other one that we had to look at was Roku, because this is in a bad way. We're down 43%, not quite 50, but today it's rallying. So, you know, maybe Roku will pull itself up by its bootstraps. And again, we have this harami down near a support level. But, you know, this one, pretty worrisome also, right? So if this one hasn't moved by Monday, then, you know, we exit that one as well. Okay, so let's have a look at a bearish opportunity. And if we look at CMG, you know, this is a stock that is down. This is Chipotle. It is down 47% year to date. And, you know, it gapped down on the last earnings. So that's not encouraging. But it's been kind of going sideways ever since. So if you looked at that and you thought, okay, today it's up. And so you might choose to wait for another, you know, candle of indecision. But if we looked at this and said, hey, you know, it's been kind of trading in this sideways pattern for over a month now. You know, it started at, well, sorry, October 31st. What's today's date? The 21st. Yeah, at the better part of a month, 3 weeks. So could we, you know, place a trade with the expectation it might stay somewhere below that like 32 mark? So if we came here to December, well, we'd have to do the 32.50. Now, what's the problem with this? You know, it trades more than 1 million shares a day. We've got tons of volume. We have a 14-cent bid-ask spread. And this next strike, it's only 3 cents, but it's 31 cents. So there might not be enough premium in this for it to be worth our while. Well, and then you look at it and you say, well, if I could get a credit of 68 cents, how much am I risking? I'm risking 250 less that 68 cents. So I'm risking 63. No, I must have made a mathematical error there. 250. Oh, 250 minus 68. $1.82. So if we're risking $1.82, what might our return on risk be? 68 divided by $1.82. That's a potential return of 37%. And so if we look at this and our guideline in our example trading plan is, hey, if this is, if we're going to be in it for potentially 28 days, a max of 28 days, then at 30, are we getting at least 1% a day? And it's not that you're expecting to get a return of 1% a day. It's just a way of trying to look at timeframes and create some type of standardized goal. And so if we said, okay, that would meet our requirements. And so we're going to come to first trigger sequence, right click, create an opposite order. And how many of these can we do? Well, we could do 3. Let's see. I think we could do 3. Let's see and we're going to make this 13 cents. Oops, only 1 period in there. Good till canceled, confirm and send. Oh, we're risking 546. So let's just make it, we'll err on the side of caution. We're going to make it 2. So our expectation then is for Chipotle to stay below 32. And so this is a neutral to bearish in that we're kind of sort of bearish. And if it just continues to go sideways, we're okay. It's currently trading at 31.75. So we've got 75 cents worth of wiggle room. And if this was a $200 stock, you might say, like, that's not enough wiggle room for me. Other people might say, yeah, but this is a $31 stock. So proportionately speaking, it's a little more significant. And then if we want to put that on our chart, we'd make that 32.50. And this is December 19th. Okay. So that is Chipotle. Now let's look at Celsius Holdings. I guess our new trades are perhaps brought to you by the letter C. Now, when we look at Celsius, and this is one that we did very well on earlier in the year. This is a stock that's still up 52%, but on the last earnings, it dropped and has been falling since, but it may have found a base here. And so what some might do in this case is say, yes, it's recently been downtrending. If we come out to the year to date on this, it's had a pretty nice run to the upside, but perhaps given this candle, which is indicating change, we might want to wait for it to move back up here closer to that 42.50, where we get more of a premium if it then rolled over again. So with this one, we may just want to exercise some patience. Okay. Now let's come and look at GM. And every time I see GM, and I used to live in the Metro Detroit area. In fact, I'm heading back to Michigan for Thanksgiving to spend some time with some friends. But I think good morning when I see GM. And this stock is up 31% year to date. And when we look at this, it had a nice move to the upside and has been consolidating. So if we wanted to say, if we're kind of sort of bullish on this, instead of saying I'm kind of sort of bearish, could we sell a put? So do a short put vertical below this 66.85 level. It's currently trading at 70. So could we sell something at the 66? And is that even available? So if we come to December, we'd have to do either the 65 or the 67.50. The 67.50 is really higher than we want it to be, right? How about if we came to December 12th? That's only 3 weeks away. then we could do, say, a 68. We still have over 100 contracts. So here's our 6685. We could do 67. We could do 68. So if we did the 68 and the 67, we'd get a 27-cent credit. What if we went to 68 and 66? 48. Well, we're taking double the risk, but we're not getting double the premium. We're getting like $7 shy of that. So maybe we'd say 67, you know, and so what's the difference? Well, you're going to have to pay more to get in and out. Also, the probability of it going through both strikes is higher when the spread is tighter. But, and then is it even worth it? Well, if we say, well, we're risking $63 a contract for the chance to make 27. So if we say 27 divided by 63, that's a 42% potential return. Does that meet our criteria for something we'd be in for, 21 days max? It does. So if we're risking 63 cents, where's my, how many of those could we do for 500? About 8, 500 divided by 63. Okay, we could do, if we did 8, we'd be just over. So if we say, okay, we're going to do 8. Can you share your grid? Mary Bynes is saying the 3-year chart on Chipotle shows a bear flag, so it supports a bearish trade. Thank you for pointing that out. Yes, I'm hoping to watch the Lions game on Thanksgiving. I am a Lions fan. There, I'm out of the closet on that. For a long time, it was a labor of love because they weren't doing so well. And so with this, we're going to say, hey, when this is worth a nickel, we want to buy it back and take our risk off the table. And how many of those were we going to do? We're going to do 8. Okay, make this good till canceled. Confirm and send. So the max loss 584. That's one too many. Okay, so we're going to do 7 and 7. Okay, 511, that's better. And we're going to put that in our short put vertical group. Okay. Oh, 73 and 27. Yeah, my math skills suck, don't they? Today, sorry. That wasn't very nice language. Okay, 27 divided by 73. Still, okay, so that's a 36.9%, or you could round it to 37% return. Yeah. And so if we draw that, oh, did I do 68? Dang it. I did 67 and 68. Well, we'll see how that works out. I really wanted that to be 67 at it. We made that 68. So you may want to go in and put a note in there because, that's a little tight. I would rather that have been the 67. Okay. Okay, so somebody's asking about these scripts here. So if you go to my X feed at the very top, there's a post pin there that has both the scripts and instructions on how to do that. The other thing that I saw a question on was like, where are these plans of which you speak? And if you go to the Trader Talks channel from Schwab Coaching, let me just bring that up. Okay. So here we have it. Let me just size it to the page. What comes up first is whatever's currently being taught. So that would be trading a smaller account right now. And then if you come to playlists and you scroll down to the trade management mini sessions, I've been creating a bunch of short vertical, like a short mini micro minis on candlestick patterns. But then if you keep going down, here's these example trading plans. I pointed this out also in the last class. So today we did short call vertical as an example and a short put vertical. So if you want to see a framework for an example trading plan, you can watch these. Okay, so guys, that's a wrap for today. We reviewed 4 example trades. You know, 3 that were profitable, 2 on Google and 1 on Adobe, and then 1 on CSX, which was a stock trade that was not profitable. Okay, and then we did a quick review on our long call vertical positions. On Microsoft, we chose to exit. And on Lamb, and there was one other, we're going to, that was Roku. We're going to watch those like a hawk next week because those were down also. And then choose whether or not to exit on those. Okay, and then we placed a couple of new trades. And the new trades were on, we did a short put vertical and a long call vertical. Why does my Thinkorswim is playing hard to get here? I can't bring it back up. Okay, I'm going to give up on bringing that back up. There we are. So we closed out Microsoft and we added new positions, a short call vertical on Chipotle, a short put vertical on GM. So guys, if I don't see you between now and Thanksgiving, have a really awesome and wonderful Thanksgiving. Mike has reposted a couple of times. There is a survey in the chat. And so if you would fill that out, I'd appreciate it. It is 2 questions, everything from 1, which is I hated it, to 10, I loved it, and I'm going to be a regular and keep coming back. And then there's the ability to put comments in if you like. If you provide me with some feedback, did you like the pace? Are there topics you'd like me to cover in future? If you put in a comment, I promise to read it. So will the management team. Hit the like button. It's a chance to do a random favor for a stranger without leaving your desk. And, you know, you can make a difference. And it just moves things up in the YouTube algorithms. And it lets me know that you thought this was valuable. So hit the like button, subscribe to the channel, fill out the survey, follow Mike and I on X, Mike Fairborn CS and Barb Armstrong CS. If you're coming to Anaheim, please come up and introduce yourself. Can't wait to meet you. We're just going to go as a team and start getting things set up. We've got gift bags for everybody and, you know, the whole bit. So, yeah, take care of yourselves, guys, and we'll see you in a webcast coming up soon. Bye for now.